Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, New Scale Power, ticker SMR. We are closing the books on the second week of January 2026. And if you have been watching the tape, you know the bleeding has finally stopped. The stock is finding a floor, trading in a remarkably tight channel between 1970 and 2020. But look, the price action is secondary to what I'm seeing in the volume. Look at the gap-up events we saw on January 5th and again on January 9th. We had over 30 million shares change hands on those days. That is well above the 25 million daily average. That tells me the capitulation phase is over. Someone with deep pockets is stepping in to absorb all that supply.
I come at it from such a different way. You're looking at a microscope. I'm looking at a crime scene. You're seeing 2 weeks of stabilization. I see the blast radius of the last quarter. I mean, we can't just gloss over the fact that in October 2025, just 3 months ago, this stock was trading at an all-time high of $57.42. Investors bought that breakout. They bought the narrative, and they have been absolutely incinerated by a 60% retracement down to $11 in December. You call it stabilization. I call it a dead cat bounce on a chart that is fundamentally broken.
Okay, I see why you think that. Focusing on the retracement, it's painful for those who bought the top, absolutely. But that volatility is exactly why we're talking about this today. The central tension here isn't just about past price action, it's about the future. I mean, is NewScale the primary vehicle for the trillion-dollar AI energy pivot, a must-own asset? Or is it a dilution trap destined to just grind lower? I'm arguing the former. We're seeing a 40% year-to-date rally because the market is finally digesting the floor overhang. This is the only company with a U.S. Nuclear Regulatory Commission standard design approval. That is a regulatory moat you cannot buy, you can't hack, you can't speed run.
And I'm sorry, I just don't buy that. The valuation is completely, utterly disconnected from commercial reality. You have a $6 billion market cap built on what exactly? Soft revenue? We're talking about $8.2 million in services, basically consulting fees, not energy generation hardware. And the floor overhang isn't just some narrative annoyance. It is a structural supply ceiling. They are dumping 111 million shares through the second quarter of this year. And to make matters worse, shareholders just authorized doubling the share count to 662 million. That is a loaded gun pointed directly at equity holders. This isn't an energy play yet, it's a dilution trap.
Let's get into it then, because I think your dilution trap theory misses the mechanics of what is actually happening under the hood this January. You're seeing selling pressure and just assuming it's a vote of no confidence.
Well, it usually is.
Not in this case. The bear case right now, it relies heavily on the Fluor overhang. Now, for listeners who haven't read the filings, Fluor Corporation, the massive engineering firm, has been the majority backer of NewScale for over a decade. They're now exiting that position, divesting 111 million shares. Most people see that as a founder losing faith. I see it as a necessary maturation. Fluor's an incubator. They're monetizing a 15-year investment. But here is the key insight. Who is on the other side of that trade?
Algorithmic traders, day traders, and, retail speculators chasing a chart that looks like a roller coaster.
Incorrect. The volume profile suggests institutional accumulation. When you see 30 million shares change hands on an up day, that is not retail clicking buttons on an app. That is what we call pure play rotation. We're moving from a legacy industrial owner Fluor to quantitative growth funds and clean energy ETFs. These funds, they have a mandate, carbon-free baseload. They couldn't buy NewScale when it was essentially a Fluor subsidiary because of concentration limits. Now they can. So this isn't selling pressure, it's a changing of the guard.
That is a very optimistic way to frame a massive supply dump. But let's look at the plumbing of this trade, because the data suggests the smart money is actually betting against you, not with you. As of mid-January, the short interest is sitting at roughly 37.3 million shares. That's over 23% of the float. That is an incredibly crowded short. When nearly 1 in 4 shares available for trading is sold short, that is a flashing red light.
It is crowded, I grant you that, but context matters.
Oh, it gets darker. If we look at the off-exchange short volume, what's happening in the dark pools, it's running at about 30.26%.
When a third of the volume is executing off-exchange on the short side, that is sophisticated capital betting that this company cannot commercialize before they run out of cash. These aren't retail shorts. These are hedge funds and prop desks.
See, this is where a little knowledge can be a dangerous thing. You're looking at the raw short volume and assuming it's a directional bet, that they believe the stock is going to zero, but you have to look at the cost to borrow.
Which is low, I'll give you that.
It is incredibly low. It's hovering between 0.45 and 0.49%. Think about what that means. If this were a distressed short, if the market truly believed bankruptcy was imminent, lenders would demand a huge premium for the risk. That fee would be 20%, maybe 50%. A sub 1% borrow fee tells me this is risk arbitrage, not distress.
Okay, so explain the arbitrage mechanism you're seeing. Because to the average holder, a 23% short interest just looks like a massive wall of sellers.
It's the floor exit again. Market makers and institutional desks are facilitating these massive block trades for floor. To do that, they have to take on inventory. So to hedge that inventory so they don't get burned if the price drops while they're finding buyers, they short the stock in the dark pools. They aren't betting against NewScale. They're just neutralizing their exposure while they distribute the shares. And this creates a fascinating setup. We have a days to cover ratio of just 1.2 to 1.6.
Right, which implies they can cover pretty quickly.
It sounds like nothing, but combined with the massive daily volume, it's a tinderbox. If we break that $24 or $25 resistance level, those market makers who are essentially just hedging might be forced to cover to clear their books. That isn't a trap, it's a coil spring. You're misinterpreting mechanical hedging for bearish conviction.
That's a sophisticated argument, and I appreciate the distinction. However, even if I grant you that the shorts are just hedgers, we have to talk about the price they are hedging at. Let's zoom out from the dark pools and just look at the price tag. You are asking investors to pay for a $6 billion market cap. NewScale trades at over 60 times forward sales.
High growth commands high multiples. That's standard operating procedure in tech.
But this isn't software. Look at the peers. You have established industrial players like BWX Technologies or even Fluor itself. They trade at 1 to 3 times revenue. You are paying software multiples, SaaS multiples, for a construction business. NewScale has to pour concrete and weld steel. They don't just push a code update to generate revenue. You are paying for a margin profile that doesn't exist in heavy industry.
I'm not convinced by that line of reasoning because you're comparing apples to oranges. You can't value a high-growth pre-revenue disruption play like a legacy construction firm. A better comparison is the rest of the nuclear hype cohort. Look at Oklo.
Oklo is the darling of the moment, yeah, largely due to the personality involved.
Exactly. Oklo is trading at something like 30 times price to book. NewScale is trading at roughly 7.6 times. Why the discrepancy? It's the Sam Altman premium. Investors are paying a massive markup for the Silicon Valley narrative with Oklo. But here's the irony. Oklo doesn't have an NRC license. They are years behind. NewScale has the license. It has the approval, yet it trades at a massive discount to the hype stock. In this sector, NewScale is actually the value play.
Calling 60 times sales a value play is courageous. But let's pull on that thread about the license. You say they have the mode. I say a license doesn't generate revenue. Customers do. And this brings us to the elephant in the room, the commercial reality, or the lack thereof.
We have a pipeline, a very significant one.
You have a slide deck? Let's talk about this 6 gigawatt framework agreement with Entra One Energy and the Tennessee Valley Authority. On paper, it sounds magnificent. 6 gigawatts is enough to power a small nation.
It is magnificent. It validates the technology. Entra One has access to potentially $25 billion via the U.S.-Japan frameworks. And it's not just paper. Doosan Enerbility has put over $100 million of hard cash into NewScale. They're booking forging slots. Do you know how hard it is to book forging slots for nuclear pressure vessels? You don't do that unless you are ready to build. That's moving from PowerPoint to hardware.
I view the Entra One situation very, very differently. Who are they? Go to their website. Who is the management team? What have they built? They're a black box, an intermediary. They aren't a Tier 1 EPC firm with a history of building infrastructure. They are a financial vehicle. But here is the smoking gun for me. Look at what TVA is actually doing, not what the press release says.
TVA is a partner. They are engaged.
TVA is hedging their bets. At the Clinch River site, the most important SMR site in America, TVA selected GE Vernova's BWRX 300 for the Phase 1 deployment, not NewScale. GE is winning the race to actually move dirt. NewScale has a framework agreement for future phases that may never get funded. You're betting on a Phase 2 player in a Phase 1 world. When the excavators start digging at Clinch River, they will be digging a hole for a GE reactor. That speaks volumes.
I think you're missing the forest for the trees on the TVA deal. The GE Vernova selection is for a specific, immediate deployment. It's a single unit. The 6 gigawatt deal with Entra1 is about the massive scaling required for the data center build-out. It's a different scope entirely.
But scope requires execution, and GE is executing.
And regarding execution, let's talk about the macro environment. We can't ignore the political tailwinds here. We have the Trump administration's energy dominance agenda. We have executive orders pushing for operational reactors. This is a rising tide that lifts the only boat that's actually seaworthy from a regulatory standpoint.
Okay, let's talk about that tide. Because the president signed an executive order with a very specific deadline, operational reactors by July 4th, 2026. That's 18 months away. NewScale cannot physically meet that deadline. Their timeline for Voyager plants is years out, 2029, 2030 at best.
They don't have to hit that specific date to benefit from the policy. Look at the poly market odds. The betting markets for nuclear energy expansion and AI power demand are trending over 60%. These prediction markets are often smarter than the analysts. The market knows NewScale is the only approved design. When the Department of Energy starts unlocking loan guarantees, NewScale is first in line because they have the paperwork stamped.
But the Trump trade in nuclear isn't NewScale. If you want to play the July 4th deadline, you buy BWX Technologies. They have Project Pele. They can actually deliver a microreactor by that date because it's a defense contract. BWXT is the safer play for that specific political catalyst. NewScale is just speculating.
No, BWXT is a defense play. Project Pele is a mobile microreactor for the Army. It's not going to power an Amazon data center. It's not going to run ChatGPT-6. NewScale is the commercial solution. The Trump trade is about economic competitiveness against China in AI. That requires commercial gigawatts, not military kilowatts.
That brings us right back to the central problem. With cash burn eating away at their liquidity, NewScale is going to have to use that new share authorization. They didn't ask shareholders for 300 million new shares just to look at them.
I see why you worry about the cash, but look at the institutional rotation again. The January volume tells us that legacy holders are leaving, but growth funds are entering. These funds, Citadel, Susquehanna, the big ETFs, they aren't buying for next quarter's earnings. They're buying the only asset that fits their mandate.
They are trading volatility, my friend. They aren't marrying the stock. Look at the analyst targets. The spread is insane. You have Citi down at $15. You have the bulls up at 63. That variance tells you everything. Nobody knows if this business model works yet. You mentioned the AI energy narrative. Sure, Meta and Google are signing deals, but who did they sign with? Constellation, Vistra, the existing fleet. They want power now, not in 2030.
They took what was available now, but the existing fleet is finite. There are no more spare gigawatts at Calvert Cliffs or Susquehanna. To get the 10, 20 gigawatts the hyperscalers need by 2030, you have to build new. And SMRs are the only form factor that fits. You can't put a gigawatt scale AP1000 next to every data center. NewScale's modularity, the ability to stack these modules like Lego bricks, is the technical solution.
Modularity is a great engineering concept, but it introduces first-of-a-kind risk, and the supply chain for nuclear forgings is globally constrained. If there's one hiccup, one delay in the first module, that cash burn becomes a bonfire. And with Entra1 being such an opaque partner, if they fail to raise that project equity, the backlog just evaporates. It's a house of cards built on a foundation of regulatory paper.
I'd frame it differently. It's not a house of cards. It's a qualified pipeline waiting for the final investment decision. The fact that Doosan invested equity, not just signed a supplier deal, but bought stock, tells me the supply chain believes in the order book. Suppliers don't write checks to their customers unless they are sure the orders are real.
Once floor is out, The only major backer with industrial expertise has washed their hands of the project. Think about that signal. The company that knows NewScale best, that birthed it, is saying, "We'll take our cash now, thank you."
Fluor is an EPC contractor. They build things. They are not an asset manager. Holding a volatile tech stock on their balance sheet creates earnings volatility for them. They have to sell. It makes NewScale a pure play, no longer a subsidiary. That opens the door for inclusion in indices that couldn't touch it before. S&P Midcap, Russell 2000 rebalancing. These are real catalysts.
It also removes the parental safety net. Now NewScale stands alone, burning cash, with a valuation that demands perfection.
Perfection is priced into Oklo. NewScale is priced for probability. And the probability of a nuclear renaissance without the only NRC-approved design is 0. The government has spent too much time and political capital on this design to let it fail.
I'm sorry, I just don't buy that the NRC approval is a golden ticket forever. Competitors are catching up. GE Vernova is moving faster on the ground. The moat is filling up with water. And the dilution risk is immediate. Management didn't ask for 662 million shares for fun. They intend to use them.
They asked for flexibility. To build a trillion-dollar energy infrastructure, you need capital. Using equity to fund growth when your stock is up 40% year-to-date is smart management, not a trap. If they can raise $1 billion at $25 a share, that secures the balance sheet for 5 years. That kills the bear case.
It secures the balance sheet by diluting the current owners by 30%. It's smart for management. It's painful for you.
Let's bring this to a close. We've covered the technicals, the valuation, the commercial reality. Where do you land on NewScale as we head deeper into 2026?
Look, I view NewScale as a trading vehicle, not an investment. The risks are structural. The floor supply overhang is going to cap rallies for the next 6 months. That's just simple supply and demand. Enter1 is a black box risk that I cannot underwrite as a serious investor, and the cash burn guarantees they will use that loaded gun of share authorization to dilute you. If you want nuclear exposure, look at Cameco for the fuel or BWX Technologies for execution. NewScale is a lottery ticket with a very, very expensive price tag.
I see why you think that, but let me give you a different perspective. NewScale is a mispriced asset with a regulatory moat that money simply cannot buy quickly. The liquidity absorption we are seeing in January, those 30 million share days, proves that smart money is positioning for the breakout once the floor exit is complete. In a world that demands reliable gigawatts for AI, the only approved design will inevitably capture value. The volatility? That's just the price of admission for what could be the most important industrial stock of the decade.
Well, 2026 is certainly the show-me year. We're moving from paper pipelines to the need for concrete reality.
Exactly. The transition from PowerPoint to power. There is certainly more to explore in this material as the year unfolds.
Indeed.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.